life. We are scolded and told we can't afford that, or stop thinking about yourself, it's selfish.
We are taught to be content with our lot in life.
But the mentor taught that you have to tap into that desire. You have to ask, what is in it for me? You need to sit down in a quiet room and vividly ask yourself, how can I engineer my life so I never have to wake up to an alarm clock again?
What would it take to be completely free?
That little spark of greed, that intense desire for personal freedom, is the only thing powerful enough to burn through the laziness of the rat race.
Okay, this brings us to obstacle number 4, bad habits. And this is where we have to have a serious debate, because the philosophy advocates a habit that sounds not just counterintuitive, but borderline unethical and reckless.
I know exactly which one you mean.
The cardinal rule is pay yourself first. The mentor says he takes his income and puts it into his asset column before he pays his mortgage, his creditors, his credit cards, or even the IRS.
Yes, before everyone.
Now, if I am broke and the bill collectors are calling my phone 5 times a day, threatening to turn off my electricity, isn't it wildly irresponsible to take my paycheck and buy a stock instead of paying my past due bills?
It sounds incredibly reckless to the middle-class mindset, which is obsessed with being a good, responsible citizen. But let's look at the underlying psychology here.
Okay, defend it.
The mentor explained that the government and bill collectors are essentially bullies. If you follow the traditional advice, which is pay everyone else first and save whatever is left over, you are acting like a 96-pound weakling getting sand kicked in your face at the beach.
Because there's never anything left over.
Exactly. You let the bullies drain your resources, and you inevitably end up with zero left over to invest in your own future. You sacrifice your financial life to appease the bullies.
But if you pay yourself first and route the money to your assets, you literally don't have the cash to pay the bills. Don't the bullies still come after you?
Yes,
Yeah.
they come after you harder, and that is exactly the point. When you pay yourself first, you inevitably come up short on your bills. The pressure from those creditors builds up. The late notices arrive.
Sounds incredibly stressful.
It is. But instead of dipping into your precious asset column to appease them, you use that intense, terrifying pressure to motivate your financial genius.
You weaponize the anxiety.
Precisely. The fear of the bill collector forces you to hustle. It forces you to think creatively. You realize you have to generate more income, so you start a side business on the weekends, you figure out a new sales tactic, you negotiate a massive deal.
It is the equivalent of going to the financial gym and lifting heavy weights.
You use the pressure of the external world to make your internal financial muscles stronger. If you pay them first, you relax, you get weak, and you stay poor.
It is a wild, aggressive way to look at it. You have to have incredible internal fortitude to withstand that pressure without cracking.
You really do.
Which leads naturally to the final obstacle, arrogance. The philosophy defines arrogance with a very simple equation: ego plus ignorance.
People use arrogance to hide what they don't know, especially when it comes to money.
When a sophisticated investor knows they are ignorant about a specific new tax loophole or a new crypto asset class, they drop the ego immediately. They go find an expert, buy a book, or hire a consultant.
The arrogant person just dismisses the new asset class as a scam because they are too insecure to admit they don't actually understand it.
Which brings us to the final phase. Step 6, the action plan. We have covered the theory, the mindset, the math, and the psychological roadblocks.
But philosophy is totally useless without execution.
Right. How does the listener sitting in their car or at their desk actually start putting this into practice today? The framework outlines 10 specific steps to awaken your financial genius. Let's rapid fire the most crucial ones.
Step 1. You need a reason greater than reality. If you just say, I want to be rich so I can buy a boat, that is not a strong enough foundation.
No, because when the real estate deal falls through or the stock market crashes, a superficial desire will just shatter.
You need a deep, visceral, emotional why. It has to be a combination of deep loves and deep hates.
Like, I hate being an employee and asking for permission to go to the doctor. I hate that my parents are struggling in retirement. I love the idea of having total control over my Tuesday afternoons.
If your reason isn't anchored in your soul, the reality of the rat race will crush you.
Step 2 is to choose friends carefully. This is about the brutal reality of association. You become the average of the people you spend the most time with.
The mentor learned from both his rich friends and his poor friends, but he paid special attention to his wealthy friends for what he called legal insider trading.
Legal insider trading. I like that.
They talk about money openly, They understand where the markets are flowing, and they are close to the inside where the real opportunities are born. Crucially, he warns to aggressively filter out the frightened people.
The chicken littles we talked about.
Yeah, if you have a great idea, the cynical friend will spend an hour telling you exactly why it will fail. Limit your exposure to fear.
Step 3 is the power of learning quickly. We touched on this with the specialist versus generalist idea, but it's really about mastering a formula and then abandoning it for a new one.
The masses learn one single formula in high school, which is work hard for an hourly wage. And they use that one single recipe for 50 years.
The wealthy learn how to buy real estate foreclosures, make millions, and then immediately go looking for the next formula. They take classes on derivatives, commodities, or tech angel investing.
In a world moving at the speed of AI, it is not about what you currently know. It is about how fast your brain can absorb and deploy new recipes for making money.
Then there is step 4, the concept of being an Indian giver. This is the core of understanding return on investment, or ROI.
When a sophisticated investor looks at a deal, they don't just ask how much it costs. They ask two very specific questions.
Yeah.
How fast do I get my initial principal back? And what asset do I get to keep for free once my money is out?
The holy grail of investing is to put $50,000 into a property, pull that $50,000 back out through a cash-out refinance 2 years later, and still own the cash-flowing property.
Your initial capital is returned to you, your risk is zero, and you have a free asset generating infinite returns.
Step 5 is a behavioral quirk. Pay brokers well. So many middle-class people try to save a few pennies by using discount online brokers, or they try to sell their house themselves to save the 6% commission.
But if a professional, a tax attorney, an accountant, a real estate broker is truly elite, their fees should be a fraction of the money they make you.
You want brokers who are actively investing in the market themselves, not just salespeople reading a script. If they are making you rich, you want them highly motivated and well compensated.
And finally, teach and receive. This relies on the universal principle of reciprocity. The self-made mentor, despite being a ruthless capitalist, gave money away constantly to his church and to charities.
He firmly believed that if you want something, you first have to give it away.
If you want money, give money to a cause you believe in. If you want more sales in your business, go out of your way to help someone else make a sale. It is a psychological trick that forces you to operate from a mindset of abundance rather than clinging to a mindset of scarcity.
To tie all of these action steps together, the foundation, the corporate shield, the ROI, we have to look at the epilogue. It offers a brilliant, concrete case study that encapsulates this entire deep dive.
It's called the $7,000 college solution.
And the setup is incredibly relatable. A friend of the author was in a state of sheer panic. He had 4 kids, and he calculated he needed $400,000 to send them all to college.
And he was trying to achieve this by saving $300 a month from his W-2 salary.
Mathematically, he was never going to make it. He was building the skyscraper on a concrete slab.
So he shifted his mindset. He stopped relying on his labor and applied financial intelligence. He took $7,000 of his savings and went looking for an opportunity.
And he found a house in Phoenix that had been foreclosed on during a market dip. He bought it, rented it out, and it generated a tiny bit of positive cash flow, maybe $40 a month.
But the cash flow wasn't the play. The market recovered, the property appreciated in value, and a few years later, he sold it for a massive profit.
Now, normally, if you sell a house for a massive profit, the tax bully steps in and takes 20 or 30% in capital gains, right?
Exactly. But because he understood the legal pillar of financial IQ, he used a specific mechanism in the U.S. tax code called a 1031 exchange.
Let's explain this simply because it's crucial.
A 1031 exchange allows an investor to sell an investment property, take all the profit, and roll it directly into a new, more expensive investment property without paying a single dime in capital gains tax at the time of the sale.
You are legally kicking the tax liability down the road while your entire pool of capital continues to compound.
It is the ultimate cheat code. So he rolls all that tax-free profit into a small apartment building, and that apartment building generated $1,000 a month in pure cash flow.
And here is the finishing move. He took that apartment building and placed it inside a corporate structure. When it was time for the kids to go to college, the corporation paid for their expenses out of the pre-tax cash flow. It funded their entire education.
And the best part, once the kids graduated, the tuition payments stopped, but he still owned the apartment building. The asset was still there, now generating cash flow that funded his own early retirement.
He substituted 30 years of stressful, hard manual labor and penny pinching for a single, focused application of high financial intelligence. It is the perfect illustration of everything we've talked about today.
It really brings it all together. He understood assets versus liabilities. He minded his own business. He used a corporate shield. He overcame the fear of investing, and he made his money work for him.
As we look at the big picture of this entire deep dive, the overarching theme is a mandatory transition. You have to actively choose to shift your identity from a consumer and an employee to an owner and an investor.
Because ultimately, money is an illusion. It is a shared game of confidence. It is a made-up construct, printed on paper or existing as digits on a screen, held together by our collective belief.
What is in your head, your financial IQ, your vocabulary, your ability to manage fear is the only thing that determines what ends up in your hands.
Every single dollar that hits your bank account is a choice. You have the power to choose to be rich, to be poor, or to be trapped in the middle class based entirely on which column you direct that dollar toward.
If you develop your financial IQ, you can make that illusion obey you, rather than spending your one wild and precious life being a slave to it.
It's a powerful realization.
Which brings me to a final, provocative thought for you to chew on this week. We spend so much time listening to deep dives and reading articles about building wealth and hustling. We focus on the construction, but maybe the mandatory first step isn't construction at all. Maybe it's psychological demolition.
Demolition. I like that.
I want you to think about your deepest, most tightly held financial beliefs. The idea that saving cash is safe, the idea that your house is an investment, the idea that all debt is inherently bad. What if the most dangerous threat to your financial future isn't an unpredictable stock market crash or inflation or a recession? What if the most dangerous thing in your life is your own unwavering obedience to the financial advice of people who are silently struggling just as much as you are? If you follow the advice of the middle class, you will arrive at a middle-class destination. Whose script are you really reading from? When you realize the traditional formula might just be a trap, that is the exact moment you stop being the donkey chasing the carrot and you finally take the reins.